What is the data really saying? Welcome to ChartWatch, where we break down a few key charts and explain the story the data is telling about the economy and long-term investment trends.
Good morning, everyone. Today, we are going to take a little bit of time to address the dual mandate that the Federal Reserve has. We think this is a really timely sort of commentary on that as the Federal Reserve set guidance at the beginning of 2026 post their January meeting. I think one of the things that was most interesting about that is there was a change slightly in the rhetoric as it pertained to the dual mandate. It had shifted back and forth kind of over the last couple of years between inflation and maximizing employment. And we sort of started to get the idea that maybe the Fed was going to start paying a little bit more attention on inflation. And so we thought we might spend a little time looking at CPI and unemployment. And what I find most interesting is, as you see here, inflation has started to moderate. And some people have suggested that it's been a little bit stickier. I would argue that it's only sticky because there are a couple of subsectors that have been impacted by tariffs that have maybe held it higher than we thought it otherwise would. But for the most part, it's actually started to moderate and come down. And I think some of the core sort of CPI things like shelter, which of course makes up about 50% of core CPI, have begun to moderate further and would benefit from lower rates. When we then jump over to unemployment, I think this is where the real story is. I found it interesting that the Federal Reserve gave commentary that they might start be paying attention to CPI when unemployment is the thing that might be the biggest threat to success in 2026. If you take out healthcare jobs, you actually see a rather weakening situation in the unemployment section, something that would indicate a softening in the data, not doing as well. Maybe the labor market is something to watch in 26. So what does this mean for advisors? If I'm an advisor, I'm thinking about this setup where I've got higher valuations combined with, softening CPI or improving CPI rather, and weakening labor data. I still like this setup, but I think it does mean that you need to be a little more thoughtful about how you go about allocating for your clients, some of the sectors and subsectors that might benefit or see suffering in 26 as a result of this or additional headwinds. And then when you consider for the end consumer what this means, I think all roads point to how do we continue to help the affordability issue that's widening, not narrowing in 26. It's a big hot button topic for both political parties this year. It's a big hot button topic when you consider market and economic situation and conditions. I think what we'll really be paying attention to is how does that gap widen or close as we go further forward into the year? How does affordability get better or improve? And I think as long as it continues to moderate, or we get about even 50% of the measures that the president is suggesting that we might get this year, that could be very supportive of financial markets and ultimately the client stock portfolios. That's why we remain cautiously optimistic as we head into the rest of 2026. I hope you found this useful, and we'll see you next time. Thank you.